What's going on, ladies and gentlemen? Welcome back to Story Time with Crypto Wolf, and today I have something absolutely special for you. I think you're really gonna like this one. I've done more prep work for this than I think I've done for any video yet, and it is mind-boggling. We are going to be talking about the biggest trade in history, the biggest single profit, just absolute monster of a trade. Took like 2-3 years to fully accomplish, but I'm sure you are all going to be familiar with the circumstances of how it came about, but maybe you're not so familiar with the guy who was behind it or what exactly he did and what his strategy was. I'm just saying it's off the chain. A little bit of disclaimer, regardless of whatever you may think about this guy, I'm not saying you have to like him. I'm not saying that I like him. I don't even know this, MFer. But I will say this: if you think that, he is responsible behind the housing market crash, my personal opinion, honestly, I wouldn't go as far as to say that he is responsible. I think all of these lending banks and institutions that were giving out loans that they really shouldn't have been doing, and then we'll get into what happened beyond that. But I think the people who more directly caused the crash, I would consider a little bit more responsible. If you're trading, you don't care if it's going to go up or going to go down. The point of being a good trader, what a real trader does, is you're trying to determine which direction it's going, whether you think it's going up or you think it's going down, and then trading that. Now, granted, yes, there are manipulators and people who try to move the markets and all that, but that's not what we're getting into today. So, as we're about to dig into it, quote of the day from the person that this storytime video is about: there is a disconnect between the performance in the stock market and the performance in many companies. Absolutely true. And that kind of hints at the possibility that right now we may be in the similar situation that led up to this greatest trade in the history of markets. And you'll see a lot of correlation going on with what's going on right now, and not just in the housing market. So who knows, maybe somebody out there is doing the prep work and getting things pumping for the next gigantic trade of the century. Who knows? But yeah, hey, if they can do it, you can do it. Maybe just not at that gigantic of a level. But let's get into the story. Now over here, just showing, we got the Bitcoin chart a little bit here. And at the end, I'm going to talk about, this particular person that this trade story is about did comment on cryptocurrencies and Bitcoin. And I'm going to save that one for the end and let you know what this guy thinks. So today's story time is about a gentleman named John Paulson. Not to be confused with Henry Paulson, who, if you want, an excuse to throw something at your TV or punch it, go watch the most ridiculous congressional testimony ever with Henry Paulson. Ugh. But back to the story here. So, Henry Paulson ran his own hedge fund in New York City, had $2 billion under management, $100 million to his name back in 2004, and he felt as though he could do better. He was doing all right, but he felt that in his gut that he just hadn't hit that pinnacle he planned to reach. He hadn't gotten that real big trade going. And as you can see here, we have the housing price index looking quite ridiculous. And I'm just going to be flipping through some charts here as I do it. And I've got some pictures on top of that. As a matter of fact, this guy here is John Paulson. Shrink this down a little bit. So, in college at NYU, he was nicknamed JP after JP Morgan due to his abilities and ambition. He was a bit of a ladies' man and a party boy, but in 1994 he decided to finally buckle down and get serious. He started a hedge fund named Paulson and Co., focusing on merger arbitrage. Not going to get into it. Frankly, don't care. You should know what a merger is, though. After sending 500 announcements to try to raise capital, he did not raise any money. He got canceled on for his meetings, and he just basically was receiving no's across the board. Nobody cared who he was and what he was trying to do, and he was stuck. So he decided to put up $2 million of his own money made from his own investing, in part due to a lucky venture with a friend's startup company, which happened to be a brewery that would go on to form the brand name Samuel Adams. So he did quite well with that. He had already been getting his money up a little bit, and he had a little bit to at least, back himself. Now, that first year was hard. He was beginning to wonder if he'd made the wrong decision. It was a constant rejection, and he was really second-guessing himself. It was largely his favorite quote by Winston Churchill, never give in, never give in, never, 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 that continued to motivate him. And so 10 years down the road, in 2004, he had finally just grinded it out year after year to attain that $2 billion under management. And he began focusing, or he had been focusing his efforts, on every investor, trying to make sure that he was making money for everybody. And he was legitimately putting the work in, so I gather. Now, in a world of flashy trading strategies and more and more advanced computer algorithms, his kind of soft-spoken style and calm demeanor kind of got him labeled as unspectacular. Now, at 48, he was getting up there in age a little bit for a Wall Street trader. It's a lot of times it's a younger guy's game, at least, in the swing of things. And he was still longing for that one great trade, that one giant trade, that massive profit. So, despite having $2 billion under management, his company was still only a small one amongst a flooded market of investors, traders, and titans alike. And he only had 9 employees at the time, including a gentleman named Paolo Pellegrini. Now, Paolo would become his CFO later on, but Paolo eventually, he had a career where he was working in some of the top investment banks in the world, and he ended up going back to, it was a lackluster career. He ended up going back to Harvard and graduated at 47 years old and decided he was going to stay in the US, and rather than going back to Milan. Now, despite being old friends with Paulson, the job he was hoping to get with him was already taken. But nevertheless, he told his old friend that he didn't care what the job was. He just wanted to work for him, or with him, and he would even settle for an analyst position, which is typically like an entry-level position, despite having worked for some of those top investment banks. Now, Pellegrini wasn't the best at securing new clients or negotiation. This is Mr. Pellegrini right here. And where did I say? Oh, but he was particularly adept at researching and, trying to read the market in, bigger ways, like a macro sense. So he was hoping that, this was his last shot at turning around what had been a fairly lackluster career in the field, despite, working for some of these bigger firms, but he really hadn't done anything big. Now, after a year with Paulson and Co., Pellegrini wasn't particularly shining above anyone else. He was dedicated, including spending long hours going over foreign mergers and acquisitions, but was usually skipped over for, the big investment meetings where they were throwing out ideas and stuff. He basically had more of a supplemental contribution. When the other employees, including Paulson himself, were becoming disappointed with his performance, he knew he really needed to pull a rabbit out of the hat, and he needed to do something big to keep his job. And over here on the chart real quick, I'm just kind of scrolling through some of these various, mortgage related charts. over here, Invesco Mortgage Capital. Let's see. So this kind of brings us up to the present environment at the time when this great trade takes place. And let's see if we can find it on our chart here. We will be going back to Cali. Okay, almost. Can't quite get that far back, but we are in 2007, which is interesting. It's kind of skipping ahead in the story here, but whoops. Went a wee little bit too far. What about this guy? Yep, so way back here in 2004. Now, at the time of this, you know, we were getting into the dot-com bubble, and securitization was becoming a booming instrument on Wall Street. Basically, they were bundling debts as mortgage borrowing was increasing more than ever. So these securities could be sold to investors rather than strictly being held by the banks. Now, when that dot-com bubble burst, the Fed started slashing interest rates. And these low rates began an increasing in property values, as well as a surge in borrowing that would set the stage for later events. And again, as you can see, you know, housing price index continuing to go up, and it had been for a while. But, you know, we had this confluence of events going on around this time. Now, lending companies were trying anything they could to find customers to borrow their quote-unquote money, ignoring all the customary risks. It didn't matter because they could now bundle those debts through securitization and sell them to investors, shifting the risk away from the banks. Now, this led lenders to ignore the usual risks of lending, particularly, you know, amounts such as the home prices, and they ignored credit scores and income levels, and they were basically just trying to get anybody they could to hop in here and borrow some money, go buy you a house. I mean, advertising on TV, the whole 9 yards. That's a funky chart. Let's see what we got. What's the S&P doing? So, as the Fed began raising rates in 2004, Paulson was concerned about all the borrowing. He figured it was time to start protecting his assets and his company, and obviously he wasn't alone. There begins the put options on the S&P index, and if you don't know, put options are an option to sell a specific asset at a particular price on or before the expiration date. Now, but for Paulson, he thought that looked way too expensive. He looked into potentially shorting some of these finance companies, but many had just recently received takeover offers that were squeezing the short sellers by sending the price up higher. Now, danger zone right there, you know, if you know about all that stuff, especially sending the price up when they're doing terrible and should be going down. But, you know, nothing he looked at seemed ideal to protect him and his investors' money, their assets. Now, you know, with nothing on the table yet, this was Pellegrini's chance to kind of take a shot and step up, you know, prove his worth. He approached Paulson in the hallway one day with a suggestion that they look into credit default swaps. And let's see if we can grab our little picture here. Now, these are fairly complex financial instruments, and I'm not going to get into detail and bog the story down, but where do we go here? Okay, yeah, so looked into credit default swaps, CDS. These were like an insurance contract where the buyer would pay the seller an annual premium, and if the seller's company stock prices fell, the buyer would receive a big payout. It's kind of the gist of it. Now, if the stock price rose, the only thing they would lose would be that already paid premium. So then they shifted to researching how they could buy CDS contracts from financial companies, obviously thinking that this new bubble was going to burst and these companies would likely crash in the future. Now, Pellegrini went on to set up tutorials even with different firms just to learn exactly how these instruments even worked. So, I mean, that should kind of tell you, the guys who are doing this for a living, even they had to learn what the heck was going on with these things because, again, it's not the simplest thing, that convoluted, Wall Street crap, basically. Now, after a few months of this strategy, Paulson and Co. was only seeing some small losses on the venture. They weren't making any money. And through 2005, the big lending companies were still gaining, despite things looking, fairly unstable and unsustainable. These CDS contracts were causing their profitability to suffer as the market continued to rise. Speaking of, there's our money flow right there, the M2. All right, so finally, one day, Pellegrini suggested that rather than shorting the individual lending companies, why don't they figure out a way to short mortgage securitization in and of itself? And that way they wouldn't run the risk of a company going bad, but then being taken over by another company and causing the price to go back up. Now, this idea would change the general direction of the company. They would bring in people from different brokers to teach them about the mortgage securitization market, and they would come to find out that they were actually separate subcategories for things like subprime mortgages, the riskiest of them, and the lowest quality of the mortgages. So they decided to bet against the riskiest mortgages, driving Pellegrini to keep digging deeper and deeper to find the best looking shorts, basically. We got real M2 money stock, a little bit nicer than the regular. Now, before the end of the summer, Paulson and Co. held CDS contracts upwards of $100 million for subprime mortgage securities, defaults or losses, and had only paid $1 million for them. So 1%. Now, Paulson couldn't believe nobody else was buying such a cheap protection. Paulson realized that they were early to, these trades and ahead of the market, and also that they were kind of up against a wall of liquidity. Borrowing by Wall Street banks was still surging ahead, full steam. And it was to the point where he would even say, do you realize these guys are leveraged 35-1? So despite the fact that everything seemed like it was booming, these firms are doing fantastic. People are borrowing money like crazy. Housing prices are going up. He kind of saw the writing on the wall and said, hey, this is a bubble. And eventually it's going to pop. Speaking of, look at that inflation. So he would, from then on, shift Pellegrini to subprime securities full time. This was really the biggest shift in the company's history that they'd ever done. Pellegrini would go on to set up meetings with a bunch of different mortgage lenders, including a meeting with the CEO of New Century, which was a big lender who gave home loans to people with bad credit, basically. He would ask this guy, the CEO, about the possibility of default on the loans if rates were to rise. He figured that, he saw the fatal flaw in this lender's plan, but the CEO seemed perfectly fine with that. He simply told him that they would just refinance the loans if there was any risk of default. And they actually made such high fees from refinancing deals that it was worth it for them to do so. So they would just keep on refinancing so long as the underlying property kept increasing in value, therefore, no default. And at the time, the property was, all the properties generally were increasing, and there seemed to be No end to that in sight. Nobody thought that, all of a sudden properties were going to plummet and lose value. So hearing all this, Paulson and Pellegrini, let's see if we can, there's another one of Pellegrini right there. Where did I go? They became nervous that they'd chosen wrong, because they're like, oh crap. They were worried that the CDS protections they'd bought would never pay out, since the lenders had this plan to keep preventing the defaults and to basically keep propping them up. So they sold off their CDS contracts, their existing ones, and they started buying on more recent subprime mortgages. And the reason they did this was those were ones that the underlying property hadn't gone up in value yet. So, and they wouldn't be able to refinance if rates went up in time, basically. So, but they did in fact know that it wasn't just going to be that easy. The only way their trades would be profitable would be if the housing market hit unsustainable price levels and began to fall. So this would leave borrowers unable to refinance their loans as rates went up. The problem was home prices hadn't declined on a nationwide level since the Great Depression. Now, Pellegrini went back into research mode to see how they could solve this potential dilemma. Now, late into the night, he would be grinding it out, looking into all this housing price data, looking at changes in the prices across the country, going cross-eyed, looking at charts all night. And he decided to add a trend line and do some regression analysis to smooth out the movements in the chart. All of a sudden, the answer was right in front of him. From 1975, prices adjusted for inflation, matter of fact, this guy right here, prices adjusted for inflation had gained just 1.4% annually. But by then, they had shot up by an average of 7% per year over the next 5 years into 2005. So he could clearly see that home prices would need to drop by a huge 40% just to return to their historic trend line along the regression curve. So, you imagine, okay, you have this trend line kind of splitting the middle here, taking like a mean average and coming up, and we have this big old move, beyond a regression curve even. And if you don't know what a regression curve is, let's see, try to make this quick here. Go to Bitcoin on the monthly. So here is a regression curve, or it's actually not the greatest one. Here's a couple regression curves with the various zones. So you can imagine on that chart, we have these curves coming up, and this guy is poking, well above the red. And seeing that, the market's too hot. If it were, looking at Bitcoin, you'd say it's way overbought. Now, this meant that any correction at this point would be extremely severe. Because, he could see that anytime the housing prices dropped in the past, they dipped down beyond the trend line. Imagine trend line going through the bottom here. Every time you dip, went beyond, came up, went decently far beyond, came up, and we were up here. So he showed this analysis to Paulson, and they were confident that they had their proof that the market was in a massive bubble, and this formed the key basis for their trading strategy. I'll even leave this guy up here for you for a minute. So they could see that even if home prices even just flatlined, even if they just went sideways, homeowners would be under extreme financial pressure, and there would be losses of at least the typical 7% from subprime losses. But if home prices didn't just go sideways, but actually dipped or crashed, even just a dip of 5% would equate to losses on the mortgages of 17%. Now, they couldn't guess just how much prices would fall, but they knew that these underpriced CDSs they'd been buying were a gold mine, because they knew it was coming back down, and they knew it was going to be a significant dip to the downside. So, needless to say, Paulson ramped up his buying of mortgage securities at this point. He was purchasing up to $500 million worth per day, and he was getting it dirt cheap, since he was only paying 1% annually for the amount being protected. So if he's buying up 500 million per day, paying 1%, he's only paying the premium at 5 million per day for, the whole 500. Now, he was even feeling as though this were all a little bit too good to be true. It does seem like it, doesn't it? So by the spring of 2006, they had reached their limit of just how much they could handle. The hard part was trying to be silent about their findings and not let their secret slip out to other firms, because, they didn't want everybody else jumping on this golden goose that they figured they had. Now, they knew they needed to take it even further, though. So they set out to raise money for a new fund to further take advantage of this new golden ticket trade of the century. They were walking into Willy Wonka's here. Now, despite all the new funds raising billions of dollars, Paulson's new one only managed to raise 147 million, including 30 million of which was from his own money. Now, it was certainly less than he was hoping for, but he knew he couldn't let this golden opportunity slip away. He knew it was now or never. It's time to go shopping. It's time to start buying it up. Now, they decided to spread out their trades amongst CDS contracts on slices of selected mortgage bonds and the ABX subprime mortgage index, which had just been launched in 2006. Now, their brokers were so shocked that anyone would even want to buy their CDS contracts that they went as far as to call up and speak to Paulson and members of his crew personally, trying to talk them out of it. They were sure that he was making a huge mistake and wanted to try and protect their clients. Now, by the end of 2006, Paulson was gaining some notoriety as other investors were beginning to grow weary of, the mortgage and property market. They too were now choosing to invest in Paulson's new fund. This led to the fund now having 700 million under management, and naturally they pumped every bit of it into subprime securities and even started a sister fund to continue making similar trades. And at this point, even despite the gigantic positions Paulson was holding, remember, he was shorting the housing market. He was beginning to get worried about the effects of this potential housing market crash that he foresaw. Now, who would be liable for all the insurance that he'd bought? He didn't know exactly who was the seller of this insurance, but he did know that if the seller was in trouble, it would be a bad situation for all the investment banks and could even potentially bring down the entire financial system. So his next goal was to prepare for that eventuality. Okay, so sorry, I had to pause for a second there. At this time, he had been heavily shorting New Century, the mortgage lender. Let's bring up another little picture here. That's Paulson there for you. And despite the fact that their quarterly earnings had continued to rise and were only expected to continue on rising even further, he had even received a call from a salesman or something, I think it was, discouraging him or trying to discourage him from shorting the company, even going as far as to telling him how the company's biggest investor, a Wall Street whale, a tycoon, was, doing his own due diligence on this company and was sure that it was a good bet. Now, Paulson, however, was skeptical of the company's earnings reports, and he was curious to see the end-of-year data, knowing that they would have to be audited. And he pretty much suspected that they had been lying on these earnings reports and lying about, their profits and profitability. And as you would know it, he was right. In February 2007, New Century announced their earnings for quarter 4 2006, and it showed that so many of their borrowers were struggling to pay their loans that the company had to take back loans that it had sold to the banks. Needless to say, they were in deep shit. Now, the next day, their stock dropped 36%, and this was Paulson's first big profit. And as a result of that news, the ABX index also dropped 5 points. Now, for Paulson, a 1-point move in the ABX index was worth $250 million. So remember, it dropped 5 points. So his company had just made $1.25 billion on those trades alone in just one morning. Now, a few weeks later, when the fund was due to report to its investors, let's see here, bring up pictures of the guy. When they were due to report to its investors, the head of investor relations complained about a misprint on the documents. And he was saying, there's no way the monthly gains for February could possibly be 66%. They must have accidentally, left out the decimal point or missed it by one character. It has to be 6.6%, right? Nope. They were literally at this point, sitting atop Mount Olympus, watching the money flow like a river off the waterfalls, just swimming in it. So over the coming months, the biggest players in the market were fighting to prop up the market and keep it from crashing. Let's go over to the weekly here and we'll scope it out as we go. All right. So yeah, the biggest players in the game, literally pretty much all of them, really. I mean, I'm sure you've heard the names. Yeah, they were pushing people to continue buying into the subprime market. Now, Paulson was constantly having to argue, even with his own investors, with his colleagues, and even Pellegrini, to not close his positions and protect the gains that they'd already made. But at this point, those gains stood around $2 billion. But Paulson was still convinced they had yet to see the real crash. And he stood firm, ignoring everybody, insisting that he sell, that he close those positions. Now, the trick at this point that he realized would be to exit his positions just at the right time so that he would still be able to collect his profits before everything went to shit. And the various financial institutions were so deep in trouble they'd be unable to pay out. Now, knowing just how bad this was going to be for these big investment banks, he and his team got to work trying to figure out just how exposed these institutions were. And the further they dug, the more they found out just how over-leveraged these banks were, as well as how much of their assets were, hard to price in the first place, even harder to sell, and just how much liquidity they really had. Now, they knew this would cause major problems should they rapidly be in a situation where their assets are losing value, but they need cash quick. And, that's where liquidity really comes in, in this sense, is how quick can you turn things around back into cash? And Paulson and company were very worried about these big investment banks' ability to do so. And even still, at this time, the CDS contracts for these companies were still dirt cheap. I mean, it only cost $200,000 to insure against $100 million of Bear Stearns debt. And that's only 0.2%. Not 0.2% meaning like 20%, 0.2%. Needless to say, Paulson began buying up tons of CDS protections on all the major investment firms. He knew they were in a bad position for the coming crash, and he was happy to put his money where his mouth was. Now, just as he had foreseen, the collapse began. And there we are right there. But as the market began to tank, Paulson slowly started collecting on his positions, and the ADX index had crashed below 50. Investors around the globe were fleeing anything risky in a panic. Now, after ignoring his fellows for some time now, quite a while, he knew that it was finally time to sell it off and collect their profits while they still could. Because again, they knew that it was going to be a big one. And it had already gone down significantly far. And by July 2008, subprime investments had completely crashed. And Paulson had managed to exit almost all of his trades. Now, in the 2 years, the two investment funds Paulson had set up had invested $1.2 billion, and he had returned a profit of $10 billion. And on top of that, his other funds had also made returns of $10 billion. With a B. Every one of them. Now, for so long, everybody had told him he was crazy, that his investments were worthless, and that his plan would never work. And despite all that, he stuck to his plan and eventually went into the books as the greatest trade of all time. So, regardless of how you feel about the man, regardless of what you think about, what he was trading on, what he was betting on, yeah, he was betting on the housing market to crash. But, when it comes down to it, it's the people who were doing all the dirty shit that crashed the market in the first place who really deserve the blame. And then you had just bad fiscal policy. You had him creating all these ridiculous derivatives in the first place that just added so much to the bubble, and all of it over leveraged. So there's plenty of blame to go around. Whether you want to blame Paulson or not, that's your opinion. I really don't care. Frankly, I don't care either way. I respect this trade. Anything beyond that, I don't know. I don't know the guy. Frankly, I don't care. He's got way more money than I have, so not even worth thinking about. I will say this, though. The guy does have pretty good taste in real estate, I gotta say. Compared to most of these giant Wall Street tycoons. That's, what is it, Haller Ranch in Aspen. I gotta say, he's got some good taste in real estate. What you gonna do? If you go and look at some of these other guys, palatial estates and mansions, honestly, most of them are ugly. And to give a little epilogue here, let's say how things kind of worked out for everybody in the story. So, shortly after all this, Paolo Pellegrini and his wife were on vacation in the Caribbean. Let's see, we'll get a picture of them here. They were on a vacation in the Caribbean when his wife went to the ATM to withdraw some cash. Now, she had just happened to check the balance just as Paulo's bonus had hit his account. And she knew things had been doing well, but Paulo had been incredibly secretive about their trades for so long now, she really had no idea what they had actually accomplished. Now imagine her surprise when she saw the balance on the little screen read $45 million. Yeah, I would like that feeling too. Paolo's last-ditch effort to make something of his financial career by hooking up with Paulson had eventually gained him a net worth of $175 million after just those few years. And as for old Johnny Paulson over here, you know, he had finally hit that pinnacle that he had been dreaming of for so long. His own personal cut of the profits from that trade added up to $4 billion, the largest one-year payout in the history of the markets. And he even, you know, eventually went on to be, you know, big Wall Street guy, you know, real popular, even up to the point of doing, you know, a little question and answer interview with Donald Trump during the 2016 presidential campaign, soon to be president. You know, whatever you think of the guy, hey, from Paulson's perspective, that's got to be pretty cool. So what do you guys think about this trade? I mean, again, however you feel about the dude, you got to respect the trade. It was a monster. It was a beast. And, you know, I'm sure anybody watching, listening, any of the traders out there would probably give your left nut to be able to do a trade like that. Or ladies, you know, the other left thing you got there. Try not to be all graphic here. But, you know, I think one of the things that really stands out from this to me is, you know, the whole thing about everybody telling him he was wrong, that it was stupid, that it was never going to work, that he's betting against the market. And he stuck to the plan. He stuck to it. He stayed strong. He kept, you know, they kept doing the research. They kept looking into it. They kept making sure, you know, okay, is this the right thing to do? Are we on the right path? And as they kept finding, you know, more data that confirmed their little hypothesis, that they felt even stronger about it. And eventually other people started catching up and feeling the same way too. And obviously in the end, it worked out spectacularly well. So just to throw in, you know, since we're done with the story, I'm going to throw in some interesting little tidbits that I happened to come across. Like, well, where did we go? What do we got there? Oh, that's another one from that. Here we go. Now I gotta say, there's a lot of these tabloid type stories of old Paulson here with his wife. And a funny story. So one time it just so happened they were going somewhere and Paulson's wife and his girlfriend showed up at the same place at the same damn time. You know, that's got to be a little bit awkward. At a certain point, you know, either he had to blow off the girlfriend and, you know, play her like a nobody, or dig it in super deep with the wife. Either way, I'm pretty sure things didn't go so swimmingly at home that night, assuming he went home with his wife. Although, you know, there is the slim chance that maybe he went home with both and had an even better time, but I'm kind of doubting that. I mean, it's not exactly, you know, a young Brad Pitt over here. But just another little picture. That's the girlfriend. I gotta say, you know, I mean, hey, you know, he's got good taste in houses and, you know, not so bad taste in ladies either. Now, from the beginning, you might remember that I had mentioned that, you know, he's not to be confused with Henry Paulson. If you are not familiar with this douchebag right here, his name is Henry Paulson. And if you want to go back and see probably one of the most frustrating to watch congressional testimonies of all time, it's back in like 2008, 2009, I believe. he was testifying, I think in front of like the financial committee, and oh my gosh, they're asking about where the bailout money went and all this stuff, and just don't have anything in your hands because you might throw it at the TV. And again, I gotta say the Aspen place is nice. He had another one in like Costa Rica that was friggin' beautiful looking. So I mean, at least he's got some kind of taste. Unlike a lot of these rich people. Trying not to curse. But I told you I would get to Paulson's position on crypto and Bitcoin because, this is a crypto channel and I try not to stray too far from it. But these stories, there's not a ton of giant dramatic trading stories for crypto, but we just happen to have it over here. So, billionaire John Paulson warns cryptocurrencies will be worthless. Bitcoin too volatile to short. Markets and prices, Bitcoin news. So, kind of a little dichotomy here, kind of going both ways. So, billionaire hedge fund manager John Paulson, famed for making a fortune betting against the U.S. housing market, said that cryptocurrencies are a bubble that will prove to be worthless. While he sees unlimited downside in crypto, he will not short Bitcoin, however. Even though I could be right over the long term, in the short term, I'd be wiped out, he explained. John Paulson, the president and portfolio manager of U.S. investment firm Paulson & Co., is an American billionaire hedge fund, yada, 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 yada. Paulson shared his views on cryptocurrency and Bitcoin on Bloomberg TV Monday in an interview with Carlyle Group founder David Rubenstein. Responding to the question of whether he's a believer in cryptocurrency, Paulson affirmed, no, he is not. He elaborated, I would say that cryptocurrencies are a bubble. I would describe them as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent that the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies except that there's a limited amount, the hedge fund manager added. Cryptocurrencies, regardless of where they're trading today, will eventually prove to be worthless. Once the exuberance wears off or liquidity dries up, they will go to zero. I wouldn't recommend anyone invest in cryptocurrencies. Paulson was further asked, why not put a big short of some type on crypto since he believes they will become worthless? He explained, the reason we shorted subprime in size was because it was asymmetrical, shorting a bond at a par that has a limited duration that trades at 1% spread of treasuries. So you can't lose more than the spread in the duration. In crypto, there's unlimited downside, so even though I could be right over the long term, in the short term, I'd be wiped out. In the case of Bitcoin, it went from 5,000 to 45,000. It's just too volatile to short. What do you think about John Paulson's comments on Bitcoin and cryptocurrencies? Let us know in the comments section below. Not their comment section, my comment section. Screw their comment section. How do you guys feel about that? At a certain point, I also want to say that, you want to stay realistic. Obviously, we all love Bitcoin. We love crypto. We love what it's about. We love the utility, the basic fundamentals, the official scarcity and its limited supply. But yes, with anything, you do have to remember, nothing is set in stone. Nothing is absolute, whether it's Bitcoin or whether it's the S&P 500, whether it's gold and silver. You always have to entertain the fact that it could crash. It could super crash. It could go to zero. The entire market could just blow up in a fiery ball of, horrible nightmares. But as long as you kind of keep that in mind and, practice risk management, try to include as much safeties as you can to a point. You know, if you are hodling long term, you know, you generally want to keep up with the macro market trends. And I would say it is more advantageous to, you know, try to sell the top as opposed to just, you know, holding on for dear life forever and ever and ever. Not saying that you shouldn't, not saying you should, not financial advice. But even from a mathematical perspective, you know, if you're holding through here, market's turning on you, and you sell, and you buy back here, you are keeping that profit level and continuing it back here with more upside, as opposed to taking, you know, all the way to here before you regain that level that you had at the previous peak. But it comes down to different kinds of investors. And that is why I am big on trading, why this channel revolves around trading for the most part, is because whichever direction it's going, we can trade it. We could trade it going up. We could trade it going down. We can trade it going sideways-ish. Now, obviously, if it just goes flatline sideways, I mean, technically, you could still trade it if you zoomed in super far and you're getting these tiny little fluctuations. As long as the price is moving, it can be traded. And at least then, if the market crashes, so what? You know, you short it. Short it. And if it's pumping, you long it. And in the end, whichever way it goes, doesn't matter for your trading accounts. Now, as I'm sure most of you do too, you know, I hold on to longer term hodl positions on a bunch of different coins and tokens. So naturally, I want the overall price to continue to increase. And provided that nothing, you know, terrible happens to it, as long as Bitcoin can generally continue as it is, you know, due to the scarcity and, you know, the halvenings, the price should continue to go up. But what do you guys think? How was it? You know, epic story, epic trade. I hope you guys enjoyed it. You know, I wanted to get it out, so I didn't sit there doing basically a slideshow of a ton of different pictures and all that stuff. Otherwise it would have taken forever, a whole bunch of editing, you know, so I just dragged in some pictures just to show you guys a little bit. And other than that, tried to let the story speak for itself. Now, what do you guys think? You know, you see the housing market right now. Do you think we're setting up for another one? I mean, I gotta say, you know, we're just starting to raise rates up. Housing prices have shot up. Inflation's high. Consumer price index is not as high as it should be, but high. You know, we very well could be inflating the bubble and heading toward the pincushion on the ceiling. You know, it'd be like Willy Wonka's factory. It's got the fizzy bubble soda. And it's just floating, 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 floating. Eventually, it's going to have to burp or it's going to hit the fan. You know, we come back here to... Oh, no, we get stopped, what? 2008. And you can still see we caught the end of the dip on this chart right here. It's an interesting... the little regression bands don't really do much on this chart. Ditch that guy a little bit. But I mean, just looking at this, that is unrealistic and unsustainable. A large part of this is based off of inflation alone, really. Now, yeah, you know, the economy could be doing better, but to just, you know, Thomas the Tank Engine just chugging up the hill constantly. You know, yeah, we had COVID dip there. And we got the Biden's fucked up policy dip there. But it's just such an unrealistic chart. You know, we're just inflating the bubble. Eventually, pincushion's gonna come around. And pop. I'm not saying it's gonna come all the way down here, but I'm saying at the rate we are going between inflation, housing, you know, all this stuff, stock market, you know, a bubble can really only inflate so much. If you keep pumping air into a balloon, eventually you're going to reach the limit of its elasticity. And something's got to give. Now, it looks like we could be letting a little bit of air out right now, taking a potential breather. Let's see what's up on the market cipher here for SPY. You know, money flow generally continuing down, though we do have a little bullish divergence going on right there. We'll see if this money flow continues up. Looks like RSI's took a little bounce to the upside there. 15, 16, 10. You know, potential signal for a reverse. DBSI a little bit weak. You know, VWAP still got a little bit time to head down, though we do have an RSI split as we're going up. So I'd say it's not, you know, we do have, oh, sorry, not that one. You know, we do have that little bullish divergence. We'll see what it equates to, but on top of everything, you know, the market fundamentals, you know, shit's crazy in the world right now. And it definitely does not appear that it's going to just magically fix itself overnight. You know, we're really not even seeing the extents of the food situation, you know, between the fertilizer prices, fuel prices. You know, I saw, what was it? One guy was talking about his family farm normally spends $300,000 on fertilizer a year, and they just spent $700,000. It's more than double. And you know how that's going to work out. It's going to hit us in the pocketbook at the grocery store, which sucks because it already has been. But all right, ladies and gentlemen, boys and girls, children of all ages, I hope you all, yeah, I saw Ethereum Classic was pumping. Is it still pumping? Damn, I'm kind of salty about that. I didn't even look back at it. Hey, VeChain up here, number 5. Nice to see, nice to see. Cardano actually doing something interesting. Luna back on the block. Bitcoin Cash moving a little bit. Man, this is like the OG day, except for Thorchain here. I mean, that's been around for a little bit, but it's been moving. I got Stellar. Look at that. That's interesting. Shiba Inu had a big pump, pulled back probably about golden pocket right there. But all right, everybody, have a wonderful day, and let me know what you think about him. I mean, obviously, I don't agree with him on crypto. Not saying that it's not possible, but I'm staying bullish, and it's not just because I hold it. Say what's up. Let me know what you guys think of the story time. I got a couple other ones I'm thinking about doing that, you know, should be pretty good as well. So, peace. Have a good evening. Love you. Stay free.